Hello, my name is Brad McMillan. I'm Commonwealth's Chief Investment Officer. I wanted to talk to you today about the very worrisome and scary market environment we're in right now. Over the past couple of days, we've seen a lot of volatility, markets moving up and down, and most recently we've seen the market drop substantially. What the heck is going on here? I think we need to take away a couple of things here. First of all, is the problems that are driving this volatility don't arise in the United States. They arise elsewhere in the world. That, in many respects, is a good thing for us here in the U.S. because what it means is those problems are probably not going to directly affect us. All we're seeing are the indirect effects in the stock market. Second of all, what that means is if we don't have the problems here, we have offsetting strengths to minimize them. The U.S. economic recovery continues to go from strength to strength. We've got job openings at a 13-year high. We've got layoffs and firings at a 7-year low. We've got multiple other indicators at multi-year highs. Almost anywhere you look, the U.S. economy is going from strength to strength, and there's reason to believe that the recovery will actually strengthen in the next 6 to 12 months. Why does this matter? It matters because ultimately the financial markets reflect the fundamentals of the real economy. They can get disconnected for a while, but ultimately, if the real economy is healthy, that provides a substantial cushion for the financial markets. And that's exactly what we're seeing right now. Over the past several months, the financial markets, the stock market in particular, have gotten disconnected from the underlying fundamentals. They ran up farther than was really justified. And right now what we're seeing is an adjustment to reflect reality. This is not only normal, it's healthy, because this is how the market continues to advance. As uncomfortable and scary as it is while it's happening, nonetheless, this is the way we kind of recalibrate to reality. And the reality is things are actually pretty good and getting better. What does this mean? Could the market go down further? Yes, indeed it could. We've seen it happen before in the past couple of years, although not recently. It could go down a fair bit further, but even that would be well within the normal range. In the October market update, I talked about heightened volatility, and I think we can expect to see that continue. But when I look at the fundamental factors, when I look at corporate earnings, which are still growing, when I look at the real economy, which is good and getting better, we're in good shape. When I look at technical factors, I get a little bit more worried. We broke a support level, the 200-day moving average. That can be bad. But when I look at other technical factors, particularly the behavior of small cap stocks, smaller stocks, they've actually led the decline and have now started to tick up, which suggests to me that even if we go down further, we're probably not going to get the hit that much harder. This is something that obviously we're going to continue to watch, and there are no guarantees. But right now, I feel reasonably confident that in the future, we're going to look back on this and say, this was a blip. Thank you very much, and I'll talk to you again if and when we need to.